Hi, Sagafi, Liberty Home Mortgage. What are we talking about today? We're talking about 6 things that you need to know on VA loans that the rest of the world's not telling you. But I've got a secret I'm going to tell you. I might even tell you more than 6, okay? So when it comes to VA home loans, there's a lot of different things that people ask questions on. I'm going to just run through some of the particulars to give you an idea of what the guidelines are, the general guidelines. We're not going to take a huge deep dive on it because this is not a VA underwriting topic I'm doing. But these are secrets and things you need to know, or just some general ideas to help you, especially if you're a veteran or you know a veteran, move along. Let's start with the easiest one, okay? Down payment. The down payment on a VA loan is no money down. VA loans are 0 down. Now, can you put 10%, 20%, 30% down if you feel like it? Of course you can. You can put down as much money as you feel like it. But getting in initially, the down payment is 0. No money down for a VA loan. I'll give you something even better. If you buy a 2-family or a 3-family or a 4-family, you can still go with no money down. So if you're going with a VA loan for VA financing, you're buying a home, you can go with no money down across a single, double, 3-family or 4-family. That's an easy one. Let's go with this one. No mortgage insurance. So a lot of people say PMI, okay? PMI, private mortgage insurance, is a type of mortgage insurance given on conventional transactions. VA loans are guaranteed by the Department of Veterans Affairs, and thereby it's not insured really. There's no monthly mortgage insurance. So on a VA loan, when you put 0 down, you have no monthly mortgage insurance. Just to give you an example, maybe on a conventional loan, I loan you $100,000. Let's just pretend you only put 5% down, $5,000. Let's just say we go conventional, okay? The PMI is probably, let's say $40, $50, $60 maybe. The FHA mortgage insurance premium is probably $60, $70, $80, give or take a little bit, right in there. On a VA loan, if I loan you $100,000, it's 0, nothing, okay? So VA loans, no mortgage insurance on a monthly basis. So your payment is only principal and interest, taxes, and homeowner's insurance. So on VA loans, that's all your payment is. There's no additional mortgage insurance. So on an apples to apples comparison, the payment's going to be lower than FHA with mortgage insurance premiums paid monthly, or conventional with less than 20% down, because there's monthly PMI on those. So VA gives you a lower payment on that. Let's look at another one. Your benefits never expire. If you're given VA eligibility, like let's say you have VA eligibility from 30, 40, 50 years ago, it doesn't matter. Your benefits never expire. You can be 90 years old. You could have fought in the Korean War, Vietnam, any one of those, served in the military. You could have served in the military. Doesn't matter how long ago. Here's the best part about it. Your benefits never expire. They're never gone, okay? We need to get what's called your certificate of eligibility. The lender can order that for you. You can order it yourself. I always tell people if you don't have it, we'll get it for you, make it as easy as possible. But ultimately, your benefits never expire. That's reason 3. I started this video with 6 reasons. I think I might give you a few more than 6, okay? Another one, there's a big one. You can reuse your benefits, okay? It's reusable. That means if you used VA financing to buy a home, and then you're going to buy another home with VA financing, you sold that one and you want to buy another one, you can use it again. So you could reuse your benefits. Just because you use it once doesn't mean you're done. You can use it again. Another one for you is this one. You can actually have a VA loan right now, and let's say you relocate to a different part of the country and you want to turn this one into a rental property. You can buy another home, VA, go with no money down while you still have the other VA loan out, and that house is now a rental property, and now you own this new house VA financed, 0 down, while still owning a rental property there. So you can reuse your eligibility. Now mind you, if you're VA on this house here and you want to buy a house 3 streets over and go VA again, that's gonna be pretty hard to do, okay? So it's pretty much relocating, moving to a different part of the country, job relocation, maybe divorce situations, certain things like that. But ultimately, you can reuse your benefits, okay? Let's look at another one here. You could have had a previous foreclosure and still qualify. You could have had a VA loan in which you were foreclosed on. A lot of circumstances and situations come up in which something, you lost your job, you lost your overtime at work, your pay was cut, you got divorced, something like that happened. Maybe you went through foreclosure and maybe it was a VA loan, and then you want to come back to the table 10 to 15 to 20 years later. Now for VA, you just have to be 2 years out of a foreclosure to come back to get the loan, to apply again. In certain circumstances, you can come back. There's certain bankruptcy situations. I won't go through all that right now. But at the end of the day, even if it was a VA loan, you can come back and get another VA loan. Even if it wasn't VA, you can come back and get another VA loan there. The funding fee. So VA has something called a funding fee. A lot of people ask if they pay that out of their pocket. The VA funding fee is not paid out of your pocket. You do not pay the funding fee out of your pocket. So VA has something called a funding fee. Now, they will waive the funding fee in certain situations with exceptions to it. But if you have to pay the funding fee, it's not out of your pocket, it's rolled into the loan. So the funding fee is not paid out of your pocket. That's a great one. There's no minimum credit score to qualify. Another great example, another great aspect of a VA loan is there's no minimum score to qualify. Here's another one. If the appraiser underappraises the house, they appraise it for the value that they believe is justified for the value of the home, and that value is less than the sales price of the home. If that's the case, they invoke something called tidewater. They will actually reach out to the buyer's agent, the listing agent, all the parties involved and say, hey, I can't get value before I issue what, the comparables and the value that I think it is. See if you can provide comparables to use to help me see if I can make the numbers work at the end of the day. So that's pretty good with VA. You go conventional, FHA, even USDA. If the appraiser uses comparables that aren't getting the purchase price of the house, they just give you the appraisal and that's the end of it. On VA, they do give you a chance to provide comparables beforehand. Not that you can't in the other transactions, but they do it there. At the end of the day, there's a lot of different attributes and aspects of VA loans. I just listed a few of them for you. Keep watching my videos. Make sure you like this, you comment, you share it on your page, and you subscribe to the page too, and follow all of my other videos, and we'll see you on the next one.